Look at this number, 400 million. That is how many ounces of silver are locked into March futures contracts sitting on the COMEX right now. Now look at this number, 85 million. That is how many ounces of physical metal might actually be in the vaults by February 27th. 400 million in promises, 85 million in metal. Someone is not getting what they were sold. I am going to show you exactly how we got here, who benefits from keeping you confused about it, and what it means for your money when the clock runs out. If you are watching your portfolio right now and nothing makes sense, that is because the number on your screen is not the real story. The real story is in the vaults. And we need to talk about what is inside them, or more precisely, what is no longer inside them. Welcome to the channel. Here I show you how the financial plumbing actually works, not how the press releases say it works. I cover the data, the history, and the mechanical reality of markets, so you can make decisions without being the last one to figure out what just happened. If that is useful to you, subscribe right now, tap the notification bell, and drop a like. Now let us get into it. Here's the thing most people completely misunderstand about the silver futures market. Most people think a futures contract is just a bet on price. You buy a contract, price goes up, you win, you close it out, you move on. In reality, every single silver futures contract on the COMEX is a legal promise to deliver or receive 5,000 ounces of physical metal. The paper is supposed to be backed by something real. That is the entire architecture. The system runs on a shared assumption that the overwhelming majority of contract holders will never actually ask for the metal. They want the exposure, not the bars. And for decades, that assumption held. Maybe 3 to 5% of contracts ever triggered a physical delivery. The rest rolled or settled for cash. Everyone nodded along. But that assumption is now shattering in real time, and the exchange's own data is the proof. We will get to why later in the video, because the reason goes far deeper than one delivery month. Let me walk you through what has changed in the last 12 months. In January 2024, COMEX processed about 6.8 million ounces of silver deliveries. January is not a primary delivery month. It is supposed to be quiet. In January 2026, same non-primary month, same exchange, 49.4 million ounces delivered, 7 times more volume in a minor month. That is not a fluctuation. That is a structural shift, and it is not just January. Total COMEX silver deliveries went from 203 million ounces across all of 2024 to 474 million ounces across 2025. The entire year doubled. Every single month in 2025 came in higher than the same month in 2024. Not most months, every one of them, and the trajectory is still climbing. February 2026 is running at a 98% delivery rate. Out of 19.11 million ounces of open interest, 18.72 million ounces have already been called for physical delivery, 98%. In a normal futures market, that number should sit in single digits. When 9 out of 10 contract holders say, "No thank you, I do not want cash, give me the actual metal," you no longer have a futures market. You have a physical allocation queue, the paper is converting, and the metal is walking out the door. Now let me show you where the inventory stands, because this is the part of the story that should make you sit up straight. In October 2025, COMEX registered silver, meaning the metal officially available and allocated for delivery, sat at 167.7 million ounces. By early February 2026, that number had fallen to 103.5 million, a 38% decline in roughly 3 months. Then, on February 11th, a single daily adjustment pulled 3.2 million ounces out of the registered category in one day. Registered silver fell to 98 million ounces, cracking below the psychologically significant 100 million mark for the first time on record. On that same day, eligible silver, which is metal sitting in COMEX-approved vaults that meets specifications but is not formally offered for delivery, lost another 4.7 million ounces. Nearly 8 million ounces vanished from both categories combined in 24 hours. Since early September, COMEX registered silver has been cut in half, from 200 million down to under 100 million in 5 months. At the current drainage rate of approximately 785,000 ounces per day, by the time February 27th arrives, there may be as little as 85 million ounces left. 400 million in open interest, 85 million on the shelf. Let that settle. And there is something else I need to flag. Before we go further, something towards the end of this video I will come back to. The mine supply side of this equation is not going to rescue anyone on a short timeline. I will show you exactly why. And the math there is just as brutal as the vault math. But first, I want to show you something that happened on January 30th, because it is the clearest window into how this game is being played. Silver hit an all-time high of about $121 per ounce in late January. Within days, it traded as low as the mid-60s, a drop of more than 40% from the peak. The day after the peak, silver dropped by almost 20%, and over the following sessions, it ultimately traded down into the mid-60s, more than 40% below the high. U.S. Treasury Secretary Scott Bessent publicly framed the move as a speculative blow-off, pointing to aggressive trading out of China and momentum-driven flows from Shanghai-linked accounts. That framing was neat, tidy, and importantly, it pointed the finger away from the exchange's own rule changes. Here is what actually happened mechanically. CME Group raised margin requirements twice in 4 days, and by January was using a more explicitly percentage-based framework tied to contract value. For silver, that meant margin requirements rose automatically as the price spiked, forcing traders to post more collateral or liquidate. The effect was self-reinforcing. Higher prices triggered higher margin, which triggered forced selling. Every tick higher triggered a larger margin call. The system became self-liquidating. Prices rose, margins rose. Forced sellers hit the market, prices fell. Margin calls on the short side reversed. It was a mechanism designed to break momentum, and it worked exactly as designed. Someone built a trap and set the trigger. Here's the detail that matters more than any headline. Options markets were already pricing extreme volatility before the main leg of the crash. On the day prices broke lower, implied volatility was already elevated, and it did not spike the way it normally does, in a genuine panic. In a true shock, traders scramble to buy protection and volatility explodes. When you see price gapping lower while volatility behaves more like orderly position reduction, it suggests a market driven by forced liquidations and pre-positioned players, not by retail fear suddenly waking up. And here's the punchline. COMEX delivery reports show JP Morgan involved in roughly 600 plus silver contracts around the crash lows. Some market commentators argue this meant the bank was taking delivery near the bottom, effectively buying physical at a discount. Others interpret the same data as JPM, primarily delivering out on behalf of clients. Either way, it underlines how large, well-capitalized players were central to the positioning on that day. Most people think the big banks are caught off guard by these moves. In reality, some of them wrote the script. China's regulators responded in a way that actually addressed the manipulation directly. Chinese regulators responded directly. They suspended several commodity funds, including the country's only publicly traded silver futures fund, and opened investigations into trading activity around the spike. Official statements have focused on irregular and excessive speculation, but details on the exact number of firms and traders disciplined are limited. Real enforcement named entities, documented consequences. The U.S. Commodity Futures Trading Commission, which has regulatory authority over the COMEX, said nothing publicly. Draw your own conclusions. Now we need to talk about Shanghai, because the American story is only half the equation. The Shanghai Futures Exchange has been hemorrhaging silver inventory at the same time as COMEX. On February 8th alone, Shanghai shed 31 metric tons in a single session. Total Shanghai inventory is now down to 318 metric tons. Into that thinning inventory, position data from the Shanghai Futures Exchange show a single, heavily concentrated short exposure in silver equivalent to several hundred tons, held through a major brokerage. International press and market commentators have highlighted this concentration as a potential flashpoint if the market turns, and that short has to cover into tight physical supply. What we do not know from public data is how much of that exposure represents proprietary trading versus client hedging, and regulators have not publicly named the individual or ultimate economic owner behind it. If the market turns against that concentrated short position with limited ability to add protection, the covering process could send silver parabolic on the Shanghai Exchange. Some analysts are drawing a direct line to the nickel squeeze of 2022. We will come back to that comparison in a moment, because the implications there are very serious. Shanghai's depleted inventory did not happen in isolation. A substantial portion of its silver was physically transferred to London in October 2025 to stabilize the London Bullion Market Association, which was facing its own delivery stress at the time. That silver never came back. The three major global silver hubs, COMEX in New York, the LBMA in London, and the Shanghai Futures Exchange in Asia, are no longer functioning as a connected system. They have fractured into three separate markets, each competing for the same finite physical supply, each drawing down its own reserves, none replenishing fast enough. And here's a dimension of the supply picture that very few people are tracking properly. India is now the world's second largest silver-consuming nation outside of China, and its appetite has been accelerating sharply. The Silver Institute documented that India imported approximately 7,500 metric tons of silver in 2024, nearly double the 3,625 metric tons from the previous year. Indian solar manufacturing capacity is expanding rapidly, and semiconductor fabrication facilities announced for construction in Gujarat and Telangana will draw significant silver demand once they come online. None of that Indian demand runs through COMEX. It goes direct to refiners or sovereign channels, which means the pressure building in the vaults does not capture the full picture of how tight global physical supply actually is. And here's another layer that almost nobody mentions. The United States once held a meaningful strategic silver reserve managed through the Defense Logistics Agency. That stockpile was essentially liquidated across the 1990s and was fully depleted by around 2002. The U.S. government no longer has a buffer. Every ounce of silver it needs for defense applications, precision guidance systems, military-grade electronics, battlefield communications, hardware, has to be purchased on the open market from the same exchange that is already under stress. You have a government with zero inventory competing for metal on a platform that may not be able to fulfill commercial contracts, let alone strategic procurement. This connects to the formal critical mineral designation. The U.S. government classified silver as a critical mineral and began allocating funding towards stockpiling programs. China, simultaneously, added silver to its export control framework effective January 1st, 2026. The country that refines approximately 70% of global silver supply just made it structurally harder to export that metal. Two governments, one metal, both moving to secure it through official channels. The exchange caught between them has 98 million ounces. And we still need to talk about what Samsung did. Because when a technology company does what Samsung did, it is not a financial decision. It is a logistics decision. Samsung C&T provided a $7 million prepaid offtake facility to Silverstorm Mining to restart the La Paria silver mine complex in Durango, Mexico. In exchange, Samsung secured the right to purchase 100% of the lead silver and zinc concentrates from that mine for 2 years. They bypassed COMEX entirely. They bypassed the LBMA. They went to a mine in Mexico and locked the production at the source. When a Fortune-ranked conglomerate concludes that the exchange system cannot reliably deliver what they need and begins contracting directly with mining operations, that is a vote of no confidence in the delivery infrastructure. Samsung is not alone. Across the technology sector, companies that depend on silver for solar cells, for electric vehicle battery systems, for semiconductor fabrication, are increasingly pursuing direct offtake agreements with miners rather than trusting exchange-based supply chains. The exchange is being routed around. That is a significant signal. The London lease rate data is equally instructive. In October 2025, lease rates for silver in London spiked to 34.9% annually, with intraday peaks touching 39%. A lease rate represents what someone is willing to pay to borrow physical silver for a short period. 39% annualized means a borrower was paying nearly 40 cents per year per dollar of silver value just to get their hands on metal temporarily. That is not a rate. That is a distress signal from the plumbing itself. Now, the industrial demand floor underneath all of this is not going anywhere. Solar panels now account for roughly 20% of annual global silver mine production. Each gigawatt of solar installation capacity consumes approximately 1 million ounces of silver. Global solar installation targets are rising every year as national energy policies accelerate transition away from fossil fuels. The demand floor is not a speculative number. It is a structural calculation, and it only moves one direction. Which brings me to the mine supply issue I promised to come back to. Even if every silver exploration project currently permitted or under review were fast-tracked tomorrow, the average development timeline from discovery to first production is 7 to 10 years. Prices at $121 per ounce will not produce incremental mine supply until somewhere between 2033 and 2036 at the earliest. The supply curve for the next 7 years is essentially locked. The deficit that has been running for 5 consecutive years, consuming roughly 40 to 50 million ounces more than is produced each year, is not going to be resolved by new projects. The Silver Institute estimates cumulative above-ground supply drawn down since 2021 at approximately 820 million ounces. Nearly a full year of global mine production has been consumed from existing stockpiles. Those stockpiles are in exchange vaults, bank holdings, and private reserves. They are the vaults we are watching drain in real time. Here is where I want to be direct with you about what February 27th actually is and is not. February 27th is first notice day for March 2026. COMEX Silver Futures. That is the date when contract holders must formally declare whether they intend to stand for physical delivery. March is a primary delivery month, the most significant on the calendar. Conservatively, open interest represents 400 million ounces of claims. If 25% of holders stand for delivery, that is 100 million ounces of demand against a vault that may hold 85 million. That alone would mathematically exhaust registered supply. If delivery intensity tracks what we saw in January and February, where 50 to 70% of contracts converted to physical demand, we are looking at 200 to 300 million ounces of requests against 85 million in supply. Most people think this is a scenario that is unlikely because historically only a tiny fraction of contracts stand. In reality, the historical pattern broke 2 years ago and has been accelerating since. For roughly the last 2 years, the number of contracts standing at the end of a delivery month has been higher than the number standing at the beginning. That is new behavior. It has never sustained over multiple consecutive delivery cycles before. Contract holders who declare for delivery are no longer getting shaken out by margin pressure, price drops, or time decay. They want the metal, and they are holding the line. Now I want to address the counter-argument fairly, because intellectual honesty matters on this channel. Open interest is not the same as delivery demand. Every contract represents both a long side and a short side. Most outstanding contracts will roll forward or settle in cash. The system is designed around that expectation, and it has worked for decades. The bears will tell you that the delivery rate will normalize, because it always has. They are not wrong about history. The question is whether the behavioral shift we have seen across 2024 and 2025 has changed the baseline expectation permanently, or whether February 27th snaps back to normal. The data says the former. History says the latter. I'm going with the data. I also want to address the nickel comparison clearly, because it is the most relevant precedent and also the scariest one. In March 2022, nickel prices quadrupled inside 48 hours when it became apparent that the London Metal Exchange had allowed delivery claims to pile up against inventory that had been pledged multiple times. The LME's response was to cancel every trade executed during those 2 days. They erased billions of dollars in legitimate profits from the books of traders who had done nothing wrong with a single administrative decision. Legal challenges were filed. The courts in England ultimately sided with the exchange, ruling the LME had acted within its rules. Almost no one faced meaningful consequences. If something structurally similar were to occur in silver, the scale of damage would be several orders of magnitude larger. Silver is not nickel. Silver is embedded in solar panels, in electric vehicles, in semiconductor wafers, in military guidance systems, in medical imaging equipment, in every major technology platform of the 21st century. A nickel delivery failure was an industrial inconvenience. A silver delivery failure would be a systemic event reaching into every sector that depends on the metal. There is also a legal reality that connects to all of this, and I am going to state it plainly because most people genuinely do not know it. The assets held in your brokerage account, your retirement account, your custodial holdings at any major financial institution are legally owned by that institution. You're recorded as a beneficiary, not an owner. If that institution becomes a counterparty to derivative obligations, it cannot meet. Current legal frameworks in the United States and across most major Western jurisdictions permit the institution to use customer assets to satisfy those obligations in a resolution process. This structure is called a bail-in. It is not a conspiracy theory. It is written into the Dodd-Frank Act and into equivalent frameworks in the European Union and the United Kingdom. I am not predicting that this happens. I am telling you it is the legal architecture that exists. Because if you hold 100% of your financial exposure inside institutions that are counterparties to silver derivatives, which per CFTC data held over 200 million ounces net short as of December 2025, you should understand what the floor looks like. I want to say clearly, I am not calling for a COMEX default. The exchange has tools it has not yet deployed. It will raise margins further. It may adjust position limits. It may invoke what contracts technically permit, which is cash settlement in lieu of physical delivery. If cash settlement happens, the exchange will call it an orderly resolution. But an orderly cash settlement instead of physical delivery is an admission written into the public record that the paper silver market could not deliver silver. Every industrial buyer, every sovereign fund, every government stockpiling program would read that admission and immediately accelerate direct procurement outside the exchange. A cash settlement would not close the crisis. It would be the starting gun for the next phase. And the geopolitical layer of timing matters here. The BRICS bloc has been developing an alternative settlement currency with partial commodity backing. The working target for the initial launch of what they are calling the unit is mid-2027. A high-profile failure or cash out on a Western commodity exchange in 2026 would not simply embarrass the institution. It would become Exhibit A in the argument that Western financial infrastructure cannot be trusted as the backbone of global commodity trade. That argument is already gaining traction in commodity-dependent economies across Asia, Africa, and Latin America. A COMEX silver event would accelerate that conversation by years. Now let me come back to the timing dynamic that is unfolding right now, because it matters for what happens over the next 10 days. Chinese markets are currently operating in the shadow of the Lunar New Year holiday period. Physical buying pressure from Shanghai is running at reduced intensity. Historically, this window, when the largest physical demand center in the world goes quiet, has been used by Western paper markets to press prices lower. The pattern is documented across multiple years. When the physical buyers step back, the paper side tends to assert itself. So there may be continued or increased downward pressure on the paper price between now and when Chinese markets return to full operational capacity. But here is the collision that is coming. When Chinese markets fully reopen, we go almost directly into February 27th. Physical demand returns at the exact moment that COMEX contract holders must declare their intentions. The paper sellers who use the holiday window to move prices lower will be meeting returning physical buyers who see cheaper silver, less inventory than when they left, and a first notice day clock that has run out. That is not a slow drift into a delivery month. That is two forces meeting head-on at a specific date on the calendar. And the Chinese government's posture tells you everything about their read on this. After January 30th, Beijing did not watch passively. They suspended 5 commodity funds, shut down 6 trading entities, and formally reprimanded 249 named traders. They took documented regulatory action. That is a government signaling that it considers physical silver access a strategic national interest, not a commodity trading curiosity. When Chinese markets fully resume and the government that has been actively protecting its silver access sees a discounted price and a thinning vault, the idea that buying pressure stays muted through February 27th is not a serious scenario. So here is my read on where we sit. There are 3 types of people watching this right now. The first group is frozen. They see the numbers, they understand something is wrong, and they do nothing because it feels too large to respond to. The second group is going to overreact, check their portfolio every hour, make emotional short-term decisions, and get shaken out of positions they should be holding through a volatile window. The third group is going to use this information to build a long-term positioning framework that accounts for structural supply stress in a critical industrial metal. I am in the third group. I'm not adding leverage. I'm not gambling on short-term futures. I'm holding physical positions and mining exposure with a multi-year horizon because the structural case does not resolve on February 27th. February 27th is a stress test, not an endpoint. Even if the exchange manages the delivery month without a visible incident, the math gets worse the following month and the month after that. The vault keeps draining. The industrial floor keeps rising. The mine supply lag keeps extending. And here's the longer frame. If gold, under a yield curve control scenario, moves toward the targets that some serious institutional voices are now discussing openly, and the gold to silver ratio compresses toward its historical long-run average, the implied silver price that results from that compression is not $77, it is several multiples of that. The infrastructure already showed signs of stress at 121. Refiners locked up, dealers froze inventory, wholesale distribution chains ran out of working capital to handle the velocity. Imagine that scenario unfolding with the vaults at 40% of their September levels and China holding the export throttle. Citigroup, one of the largest banks on the planet, published a note projecting silver at $150 within 3 months of their analysis. That note came out before registered inventory broke below 100 million ounces. In 1980, when the Hunt brothers had accumulated a corner on the silver market so substantial that they held roughly a third of total global non-government supply, the exchanges responded not with rule enforcement, but with rule invention. COMEX and the Chicago Board of Trade jointly introduced what the industry came to know as Silver Rule 7. Under that rule, the exchanges stopped accepting buy orders entirely. The market was restructured to accept only sell orders. They made buying silver on the exchange temporarily illegal by rule change, forced the price down through artificial one-sided liquidity, and destroyed the corner. The current margin methodology, the percentage-based calculations that made January 30th self-liquidating, is the digital descendant of that same instinct. Change the rules to protect the short side. The difference between 1980 and now is structural. In 1980, there was no Shanghai exchange running parallel price discovery in the world's largest population center. There was no Chinese government that had formally designated silver as a strategic export-controlled commodity. There was no Samsung contracting directly with Mexican miners. There was no India doubling its silver imports year over year. Rule 7 worked in 1980 because it operated in a world with one dominant market. That world does not exist anymore. The alternative market today is large, well-funded, and physically accumulating, and it does not answer to CME Group. February 27th is the next test. Not necessarily the breaking point, but the next moment where the gap between what is promised on paper and what exists in the vaults has to be confronted in public. The exchange will manage it one way or another. The question is what managing it costs and who pays that cost. Based on every data point I have walked you through today, the people least likely to pay that cost are the ones who already have the metal, and the people most likely to pay it are the ones holding paper promises while assuming the physical is safely behind it. Take a screenshot of this video, save it, come back on February 28th and measure what actually happened against what the math was telling us today. That comparison will be very instructive, regardless of how it resolves. 6 months from now, the way this delivery cycle plays out will be studied. Either the system absorbed the stress and people will say the bears were wrong, or it did not absorb it cleanly, and February 2026 will be the reference point going forward. Either way, you now understand the mechanics well enough to read the outcome without relying on someone else's interpretation. Drop a comment right now. Do you think COMEX navigates March delivery without a visible incident? Physical metal, mining equities, or paper futures? Where are you positioned? I want to know. I will respond to the most interesting takes directly. Share this video with one person in your life who has silver exposure and does not know what First Notice Day means. Most people who own silver through an ETF have no idea the plumbing underneath it is under this kind of pressure. The more people who understand the mechanics, the less panic and the better decisions get made when the calendar hits the 27th. If you are not subscribed yet, do it now. Every week I connect structural market data to things that actually affect your money, without the hype and without the doom. The delivery crisis, the BRICS currency timeline, the mine supply math, the geopolitical chess match over critical minerals. I'm tracking all of it in one place with one analytical framework. Stay sharp. Stay positioned.